What's up everyone, it's Scotty with Money Vesting. In this video, I wanted to talk a little bit about the S&P 500 and the NASDAQ and how bad the breath is right now in the market with respect to the rally that we're seeing at the moment. So I hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below if you're interested in joining and of course getting access to all the binds alerts, options alerts, trade ideas. Everything's going to be included, and you'll also get access to all the private live streams, all the other alerts and benefits that all the members have. We've got a little bit over 3,700 members, and the first week of the month is the best time to join. So link's going to be down below. Now, market breadth, we have discussed on the channel before. We've talked about this, and it is simply a way to track the resiliency of the underlying stocks, underlying holdings of an ETF or an index that we are tracking, right? How strong is the actual move on that index or that ETF with respect to the holdings that are in that index or ETF, right? So for example, if the S&P 500 if that's what we're tracking, our goal would be to look at the 500 largest publicly traded companies in the US and how strong is the momentum for those companies, right? Because oftentimes what you'll notice and what we have talked about on the channel before, that sometimes we can see a handful of stocks, right? Very much a concentrated rally. In other words, a handful of companies that are actually pushing higher, and that can give us an illusion, or it can really create this misconception that the market is strong, when in reality, when you look under the hood, again, devil's in the details, when the majority of the market is still struggling to find a proper momentum, find stronger upward rally here. So that's what we're going to discuss, because at the end of the day, that's really what it comes down to, because the S&P 500 and the NASDAQ are a market cap weighted index, right? They're not equally weighted. And what that simply means is that the higher the market cap, the more influence they have on those index. So of course, since Apple and Microsoft, some of the biggest companies in the world, and of course in the US, they are making up a bigger portion of the S&P and the NASDAQ as opposed to everything else. So my goal in this video is to kind of show you some of the facts and the reality behind this rally that we're seeing at the moment, and kind of let you decide, if this market has legs to stand on, or if going into next week or in the next couple of quarters, it's possible that we see this sort of divergence develop and the deterioration in the breadth that we have develop and potentially start to come back down. So I'll let you decide at the end of this video. But this right here is where we are. Now, what I have over here is the S&P 500 at the top. So that's going to be the S&P 500 index, ticker symbol SPX. And at the bottom, what I have is the S&P 500 stocks above their 200-day moving average. So again, if you think about it logically, it's really telling us what percentage of those S&P 500 companies are trading back above their 200-day moving average. Now, the reason why we use 200-day moving average is because it is a long-lasting moving average, and if the stock price is trading back above that level, it's considered to be in an uptrend. It's considered to be in a very strong momentum to the upside, and if it's trading below that level, that means it's trading below its 200 days worth of average prices. That means it's in a downtrend. It's not performing as well. The momentum is very weak. So right now what we have is 48% of S&P 500 stocks trading back above their 200-day moving average, meaning only half the market is trading past its 200-day moving average, or could be considered in an uptrend, whereas the other half is trading below its 200-day moving average, or could be considered in a downtrend. Now, the divergence happens when you notice what's happened in the past versus what's happened in what's happening right now. And I'll kind of show you the both bearish and bullish perspective, right? Because again, that's what the objective analysis, the point of that is going to be. And if you take a look at the markets here back in February of 23, so literally just a few months ago, the S&P was at 4,200, right? Almost at 4,200. We got rejected at this level right here. If you compare to where we are now, you can see that we are almost identical to where we were back in February, right? So that's a line that I've just drawn across. And then take a look at the chart at the bottom, right? This is, again, going to be the market breadth. It's showing us what percentage of stocks are trading above or below the 200-day moving average in the S&P 500. Now, back in February 1st, February 2nd, we had the breadth really high at 76%, right? So 76%, and now look at that. This is the divergence where this number is now at 48%. What does that mean? That simply means, logically speaking, there are fewer and fewer stocks that have pushed higher to make the markets go back to its February highs. So in other words, we're back to the same level we were back in February, but not with the same percentage of stocks. There's fewer percentage of stocks that have resulted in the markets to trade back up to February highs. And that's what the negative divergence is. Now, this has both a bearish and a bullish connotation. I want to go over both because, again, I don't want to be seen as pushing a narrative or anything. Bearish connotation is that there is a divergence and the market rally lacks proper breadth. And if the stocks that are indeed pushing higher, which are your big tech, of course, if they start to run out of steam, well, guess what? The market's going to start to roll over because of the fact that they are the ones that are driving the markets in the first place. They're driving it higher. And if they start rolling over, so will the market. That's the bearish connotation. The bullish connotation with this is that even though we had a very high breadth back in February, we still declined, right? So we still saw the S&P 500 come down about 9%, even though the breadth was pretty high at 75, 76%, even though we were seeing more participation, more broad-based rally, the market still ended up declining and the breadth dropped 47, 48%. The market still declined 9%. So there's no reason for why the market, should be higher if the breadth is higher, so to speak, right? So it's possible, and the bullish connotation also means that this only means more upside or more rally for the market, because if we start to see more participation, so this number, if it starts to go from 40% back up to 76%, meaning that if we start to see it, go back higher to these levels, we're only looking for more participation from S&P 500 companies, and that's going to lead to more potential upside for the markets as well. So you can kind of see it in both ways, really. I mean, it really depends on the optics. And again, I've kind of looked at some of the other Twitter posts. They're putting it in a more bearish light, that we're seeing a lot of negative divergence, and the market's really, the rally's not, super strong because of the lack of breadth here. But that lack of breadth inherently also creates this opportunity for more upside, because if more stocks start participating in the rally in the future, that leads to more upside for the market. But then you also have to consider that big tech has to continue to go up. Like, it can't be. So what really happened in the past was, let's just say that this is tech and this is all other sectors. What we've seen in the last month or two is that tech rally, right? Tech has gone up, right? So we've seen tech move up. Other sectors have stayed flat. And as tech has moved up, so has the market, because it's, again, market cap influenced. So tech has moved up. Now, the breadth is really low because other stocks are still lower, right? 48%, 49% still lower. If they start to move up as well, while tech either stays flat, right, or also moves up. So what we're seeing now is tech go up and other stocks go up. That's what's going to be creating the market to move up and break out of 4,200 for the S&P, right? That's going to be a pretty significant rally. But we don't want to see other sectors move up while tech starts to pull back. That's going to be a sector rotation, right? That's going to be basically investors and institutional investors pull out of tech and go into other sectors, and that's not going to do anything good, right? That's net. We're going to be flat. We're going to continue to trade sideways. And guess what? Since we have seen a lot of sector rotation in the last couple of years, markets have literally gone nowhere, and especially in the last 1 year. Markets have gone from energy to utilities to staples to financials to tech, and now we are moving a little bit more towards healthcare. It has rotated all over the place, and yet the market has just traded sideways. If you go back to May 22 versus where we are now, we are literally flat. And the reason for that is because we're not seeing this broad-based rally, but instead a lot of sector rotation, and we're seeing one sector outperform the other every few quarters and rinse and repeat. That's the process the market's following at the moment with this market breadth. So if you come over to the NASDAQ, the story is almost identical. So you'll notice the NASDAQ here just pretty much trading at the same level as it was, might even be a little bit higher, or might be, so it's pretty much slightly higher than where we were back in February. And if we kind of change this chart to the NASDAQ, again, percentage of stocks that are trading in the NASDAQ above their 200-day moving average, the divergence is even steeper, because again, NASDAQ's a little bit more tech heavy and more concentrated within big tech. And you can see that huge divergence in the NASDAQ, and now this number is even under 42%. So again, you can look at it from a both bullish and bearish perspective. Bearish because there's a negative divergence. This lack of breadth is going to cause the market to come down. Bullish if there's more participation, there's only more participation that can happen now, and that can lead the markets to push higher. That's considering if tech also holds up and continues to move up, and we don't see some sector rotation. So let me know what you think about it in the comment section below. My thoughts and my views personally are that tech has already moved up substantially. We've seen the valuations get a little too high. So if tech holds at this level and we see participation from other sectors, only then we get a breakout past these resistances. if we see a sector rotation as what we have seen before, unfortunately on a net basis, we're going to either trade sideways or lower once again. So let me know your thoughts down in the comment section below. As always, if you enjoyed this video, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time, and the link to our Discord and Patreon is going to be down below. As always, happy investing. I'll see you all in the next video.